Thank everyone for joining. This is the Yield Lab series at Venture Cafe. It's the third Thursday of every month. Today, this discussion is brought to you by particularly the Yield Lab Asia Pacific unit of the Yield Lab, the Federation of Funds. The Yield Lab Asia Pacific is based in Singapore. I happen to be in St. Louis. I'm Larry Taylor. I'm the co-founder of Yield Lab Asia Pacific. And with us this evening is Raj Ketkar. Raj has an extensive career that you'll hear about, and we at Yield Lab Asia Pacific are particularly pleased that Raj is both an advisor and a mentor with Yield Lab Asia Pacific. So I'll define those as an advisor. Raj has provided insights to the portfolio companies that, as a group, and you'll hear one of those units tonight when Raj talks about the case study that you'll hear. But for the mentor side, I'd like to ask Raj if, well, first of all, talk about yourself. How did you arrive at this point where you've actually ended up being an advisor and mentor to startups? How'd that happen?
All right, thanks. Thanks, Larry, and thanks to Yield Lab for inviting me here and for Venture Cafe to have me here. Hello, everyone. If I was in St. Louis in person, and if we were meeting in person, I would imagine for the folks in St. Louis, I might know some of you, or some of you might have known me. I've lived in St. Louis, not currently living there now, but lived there for over 20 years out of my 30-year plus experience at Monsanto. And in Monsanto, I had different roles in agriculture, starting from the manufacturing side of ag chems, moving on to seeds and biotech, launching a lot of new products, both in the US as well as overseas. Worked quite extensively in India and Thailand and Southeast Asia in particular at different points in my career. So launching new products. So even though working in a large company like Monsanto, when you're launching a new product, it's kind of like a small startup team almost that's really focused on doing that. So I started to get experience in that area while I was working there at Monsanto. And then over time, after leaving Monsanto, I did some consulting, and then I became CEO of Arcadia Biosciences, which is based in Davis, California. That's, I would categorize as a mature startup. I will talk more about Arcadia in the case study. As far as my experience, one of the notable features was when I led the team in India to launch BT Cotton, which is sort of a major biotech product in India. It's grown on over 90% of the cotton acres there. And that again gave me a lot of experience in working in India, working at the farmer level, dealing with public acceptance issues, dealing with the regulatory system, hiring people, building teams, and so on, and which has been useful now as I'm working with Yield Lab Asia Pacific. So that in brief is my background, and I'll certainly talk about Arcadia and my experience there as we get into the discussion.
That's a nice segue. I wanted to ask you to, in a thumbnail sketch, if you could talk about the mentoring experience in the company you're supporting with us.
Sure. So Larry invited me to work with Yield Lab Asia Pacific a little over a year ago, and it's been a really interesting experience, and I'm so glad I'm doing that. Because I'm learning a lot in the process as well. The company that I'm officially mentoring is a company called Fussel, which in Hindi can mean a harvest or it can mean a crop, depending on the context that you're using the word. But Fussel is, again, a data analytics company. There's lots of those these days that I'm sure many of you have come across. They have developed both hardware and software. The hardware, which is a set of sensors to detect the microclimate in a farmer's field. And their new version, they actually ship it in a box to the farmer. The earlier version, they were actually going out there and installing it. And now it's easy to install. A farmer can literally just stick it in the ground and turn it on. And it's really easy to install. And then they've built several different algorithms to help predict the presence of disease and moisture and so on, and then make recommendations to the farmer on when to spray, how much to spray for disease control, but then also to optimize the use of water and other inputs like fertilizer. They are specializing in horticultural crops. So, in our Midwest mindset, we always just think about corn and soybeans, large acre farming, but what they're doing is working with high value crops in India, like grapes, like pomegranate, like tomatoes, chili peppers, different types of chili peppers, and they're adding crops as they go, but these are sort of their four main crops. They've been around for about 3 or 4 years now, Larry, I think, and they are in their next round of fundraising right now. They've been pretty successful at raising money because they're already getting revenue from the sale of their services and both hardware, software, and I think obviously this is a very competitive space, but looks like they have found a nice niche in the market, and this is just taking off in India. It's still in the infant stage in India in terms of data analytics and so forth, and precision agriculture. So hopefully this company is going to go places. So I've helped them with different things like even building a team. What type of people would they need to launch new products in India, having done so myself. I've also talked about building an innovation culture in their organization and how they could do that and maintain that. What kind of systems are they going to need to support an innovation culture? And finally, also just general advice on market penetration, because I was involved in a couple of major product launches there in India, and so have some background in terms of what one needs to do or not do in launching new products in India. So those are some areas of support that I've been giving Fussel, and then I've also done a little bit of advising for one of the other companies in the cohort of companies that Yield Lab Asia Pacific is supporting.
Yeah, Raj, we really appreciate that years of experience. We won't say how many to these young companies, and they're eager and to learn and soak it up like a sponge. So we appreciate it. So this is a good time to segue to the case study. And Raj, I'll turn it over to you. I know you prepared some materials that we can walk through as a way to tell that case story. And then for everybody listening, what we'll do, if you'll write your questions in the chat bar, and we'll then walk through your questions, and Raj will be happy to answer.
Okay, so I'll share my screen and put up a presentation. It's a few slides, really to lead the discussion. So let's get started here. Okay, everybody see my screen?
Yes.
Great. So focus as a key to success for startups, and so let's talk about that. Young companies typically are prone to lose focus in their zeal to make the company successful. Typically, companies start out with very focused technology or one particular technology, a few products in that space. And then, as time goes on, 2 years, 3 years, as the company starts to grow a little bit, they start to add new projects, new product to try to find the one that will be most successful. You also get under pressure from investors and the board to demonstrate success. Investors and boards are very supportive in the early years, but as time goes on, and if you're not getting to profitability, there's going to be pressure on you as a founder or as an executive of that company to show success. And then you're going to start to diverge perhaps from your initial focus to other areas because you want to show investors, there's a range of possibilities that increase the probability of success. So you say, well, if this doesn't work, we're also working on this and this, and these are high demand areas, and we think we will be successful. And so, we're working instead of putting all our eggs in one basket, we put them in 3 or 4 baskets. And pretty soon, then that starts to impact how the company is actually operating. So, the need why focus and prioritization is important is because you want to work on the right things. The right things will be different for each company, of course, or they could be more than one right thing. So for a company, you want to conserve your resources, time and money, the most important ones. Certainly people, you want to keep your people motivated and also attract new people as you grow. You want to show, faster, you want to get to profitability faster and show success. So you need to, stay focused on that. And it is motivating to the team, when you stay focused and everybody knows what their responsibility is and what they have to do to be successful. So I'm going to talk about Arcadia Biosciences circa 2016. And that's when I started with the company, which was in May of 2016. It was founded in 2003 and based in Davis, California. At that time, there were about 80 full-time people and 15 part-time employees, close to 100 folks. It was largely a research shop. They had specialized in abiotic stress mitigation traits. But within that, they had nitrogen use efficiency, water use efficiency, drought tolerance. And their model was to license the traits to seed companies, develop the trait, license it to seed companies, and the seed companies would then secure the regulatory approval in whichever country they are in and commercialize the traits. And then Arcadia would get the milestone payments during the commercialization and development process, and then the royalty on seed sales when those actually occurred. And they had licensed traits to seed companies all around the world at that point. They did have a few other products, but these were, non-GM. They were breeding-derived traits, and they were largely in the area of nutritional quality of crops, like high-fiber wheat, reduced gluten wheat. They had a heart-healthy or omega-6 oil derived from safflower. And you can see just, when you, right now, from all of the GM traits that I'd mentioned earlier, which are big traits, and they were sort of the home run hitters, and these were the smaller products. And so they were working on all of these, but these products here, the non-GM products shown here, were almost sort of stepchildren. They were not getting the full resourcing because the big money was going to come from the GM traits. As of 2016, the company had about $4 million in revenue. They had one commercial product. They were getting some license revenue and milestone revenue. The company was also doing some contract research for USAID and for some other organizations. But the costs in 2016 were $18 million. So the company was burning cash at a pretty high rate. And this 18 million was really mostly research personnel, lab work, field testing. We found out about 25 different research projects were actively being worked on. by the company. And their long-term plan showed that it would be profitable in 2020 or 21, right about now. So that was kind of the scenario when we walked into the company. And the first thing we did was to do a strategic review in the third and fourth quarter of 2016. And we looked at detailed, we did detailed project reviews of about 25 projects. And what we found was that many of these, there was proof of concept, but still needed a lot of testing. As many of you might know, abiotic stress traits need a lot of testing. They're not quite like the agronomic traits like a BT, where you do testing and you very easily know it's going to work or not going to work. With abiotic stress traits, 1 year you can get 10% yield bump, next year you get only 4%, and the next year you might get 20%, depending on environmental conditions, germplasm, trait interaction, environmental interaction. And so a lot of testing needed to be done. The regulatory approvals in many countries had already started to slow down. And it looked like any major approvals were probably at least 5 years away just to get the approvals, let alone launching. So the probability of becoming profitable by 2020 or 2021 was pretty remote at that point. We found that the scientists were working on multiple projects at once. Obviously, small company, you've got so many projects. So, your people are working on a lot of projects, and things are not moving on any one project like they should in terms of accelerating towards commercialization. There was a lot of contract research going on, which was getting some revenue, but it was distracting from the major goals of the company. And the cash runway at the time was about 15 months. So with profitability 5 years or more away and cash runway of only 15 months, raising more funds to get to profitability, which could be 5, 6, 7 years out, was just practically impossible. So we had to do something pretty drastic. And what that was really focus. We had to make major decisions. And one of the biggest ones was that we stopped working on all of the biotech projects, save one. So even though nitrogen use efficiency and water tolerance and drought tolerance have great potential, a company like Arcadia just could not sustain itself long enough to see these to fruition. So there was one exception which we kept, which was a drought-tolerant soybean being developed by a joint venture that we had with an Argentinian company, and that was pretty far along in development. It had already gotten some initial approvals in Latin America and Argentina and Brazil. So we continued that, the joint venture continued working on that. But outside of that, we stopped all our projects and basically told all the licensees that, hey, you need to take this forward in terms of getting regulatory approvals and royalties, and we renegotiated our terms with many of our licensees. And we then focused our resources on the non-GM traits. Looking at, we looked at the food industry and the food ingredients industry, and we saw opportunities there. And as all of you would know, clearly the health and nutrition food market is booming and has been for a number of years. And we had a few really good products that we could participate in this health and nutrition food market. And a couple of the key ones was high fiber wheat, which is a wheat through some breeding traits, that we found we were able to increase the amylose content, which increases the amount of fiber in wheat. So from your normal daily consumption of wheat, like, slice of bread at breakfast or rolls at lunch and so forth, you could get your full day's quota of fiber through your wheat consumption, because most Americans do not, get maybe 50% of the fiber in our normal diets. So high fiber wheat has a lot of potential. There's a lot of gluten sensitivity out there as well, and we did some research to show that if we could market a reduced gluten wheat, that could be in demand, where somebody with gluten sensitivity could have wheat and get the texture and the flavor and the taste of wheat, but without the gluten. And GLA, which is the heart healthy omega-6 oil, of course, that is already out there, and that's a commercial product. And this led us to reduce the number of people significantly. So we cut the company almost in half. While all this was going on, there was a turnover of leadership team as well. There were turnovers on the board. So there's quite a bit of upheaval in the later part of 2016 and early 2017 to sort of really go from this wide-ranging products and technologies and focusing it down to a couple of those. And so that allowed us then to chart a new path for the company in the next 3 years, 2017, 18, and 19. So we changed fundamentally our business model from that R&D-based trait provider to an ingredients producer. We also did a cultural change from a R&D focused company to a commercial focused company. Yes, we continue to do the R&D in those health and nutrition businesses, but we added commercial capability that the company really never had before. By reducing costs, we were able to reduce cash burn by about 28% in 2017 and 18. And that increased our runway significantly. And our teams could now focus on 2 or 3 products instead of 5 or 8 that any one person was working on in the company. We launched a brand called Good Wheat in 2018, and I'm happy to say that you can buy products with Good Wheat brand in it now. There's one company in North Dakota called Three Farm Daughters that is selling Good Wheat pasta, Good Wheat flour, and marketing it as the healthy wheat that it is, that has either high fiber or reduced gluten or both. So that's being marketed now. We also made a deal with a pretty large milling company to market the product for us. And then when hemp got legalized, federally legalized in the Farm Bill of 2018, Arcadia was one of the first companies to jump into legal hemp and breeding legal hemp. This is, breeding for hemp had always been in the shadows for decades because it was an illegal product. But we jumped into that and using molecular breeding and other breeding techniques that we had, the company has now actually launched some new hybrid, some new seeds, not hybrids, but new hemp seeds that can guarantee, THC less than 0.3%. So the farmer is assured that when he's growing hemp, he's not growing THC, or he's not getting THC in his hemp. Disease tolerance, higher yield, those kinds of things. So that was launched in 2019. And with all this focus, we were able to show investors that this company is viable. And we were able to raise money in 2017, then 2018, and then later in 2019 as well. And since then, of course, 2020 was a real downer. So I left the company in the fourth quarter of 2019. Once we had really done this transformation and the pivot and built a commercial organization, and now it was more about marketing and production and sales, and I decided to move on at that time. Unfortunately, in 2020, the company could not get the revenues that they expected, because of COVID. A lot of farmers kind of balked at growing hemp, unsure of how things would go. But they've now got approval in Canada as well, and so hemp is being commercialized, and the wheat is being commercialized. So I think 2021 will be a good year for Arcadia. So that was really kind of in brief, sort of the journey of the last 4 or 5 years. A company that was started in 2003, and by 2016 had sort of morphed into, instead of from the first product, which was I think nitrogen use efficiency and drought tolerance, to people working on 25 different projects and contract research. And so it was just, the management team just kind of kept getting sucked into the shiny new thing that was coming up, and going towards that and just adding that. And before you knew it, over 10 years, a number of these technologies have been added, and the company still wasn't making money. And so, we really had to take some hard steps to bring that focus back and to the company. And now they're really running only with wheat and hemp. They've actually also sold their share of their joint venture with that Argentinian company on drought tolerant soybeans back to the partner, and for some, they were able to get a good return on that as well. So now they're really focused only on wheat and hemp, and that's a good thing, I think, as the company moves forward. So I'll just end here with some questions for all of you who presumably are all working on startups of different kinds and different products. And I want to ask you, what challenges are you facing in your company? Are you staying on focus with what your charter is or was when you started? Are you and your team working on the right projects? Are these the projects that have the highest probability of success? And which ones will get to the market fastest? Are you focused on those? Because that's a real, that's what you want to have in a startup, is you've got to be able to get to market quickly and become profitable as quickly as possible. And then, do you have the right people working on the right project? And how much runway do you have cash-wise? And if you were to focus on a few projects, could you extend that runway by prioritization and focus? So just a few questions. I'm sure there's a lot more things that we can think about, but just a few questions to throw out there. In terms of, are you working on the right things, and are you focused on the right things in your company? So I'll end my formal comments here and open it up for discussion or questions.
Yeah, thanks, Raj. And there's a question that came through already, and I'll read it out loud. What happens to the company IP when you downsize the R&D? Did it have salvage value?
Yeah, we kept the IP because those products that we decided that we did not want to further develop, they had already been licensed to seed companies, many of them. So the ones that had not been licensed, that were still in early stage development, we just stopped and didn't go to the licensing stage. The ones that had been licensed, obviously the licensee had access to some of that IP as well, and they would, and when they do make it successful, whether it is 5 years from now, Arcadia will get some revenue eventually. But yes, we kept that IP.
While other questions are coming up,
I should also add that it's Arcadia being a pretty prominent research shop. The company has over 200 patents. So they have a lot of IP in the company.
How important is that patent suite to the valuation of the company?
Yeah. So very interesting. You know, people always think that IP, just the fact that you have IP, should add significantly to the valuation. But the valuation is done only on the probability of commercial success. So if your commercial success is not going to happen for another 5 years, 7 years, 8 years, obviously you're eating up that IP life in that time. And so the value of just the IP per se is not that great, actually. So when you look at the stock price of the company or the market capitalization of the company, it's typically undervalued. Yeah. So that was part of the reason why we decided to just keep the IP that we had.
Did that IP? I noticed you'd said that the origin was it was a research shop. It was
yes.
It come out of R&D. Did the company start with a number of different technologies, or did it come out of a sort of one that sort of branched off to multiple?
No, they started off actually licensing in some very early stage work that had been done by some universities in the nitrogen use efficiency area, you know, the drought tolerance and water use efficiency area. And then what Arcadia did was we're able to put those traits into multiple crops. So it was nitrogen use efficiency rice, nitrogen use efficiency corn, canola, and so on. And same with drought tolerance. And that multiplied the number of projects that they were working on. And they were typically doing phase 1, phase 2 development and then licensing it out to seed companies. And that was typically the path.
One of the things you said early on was that there was pressure from the board.
Yeah.
Talk a little bit about that. That sounds like an interesting dynamic. Maybe not fun, but interesting.
Right. So the company did go through some transition in terms of board as well. Initially, you know, when the company was private, there was a private board made up of people who were the major investors in the company, as is typically the case. And then the company transitioned to a public company when it was listed on Nasdaq in 2015, I believe. And so there was a transition in the board. And when the new board came on, which was, there were some new members that came on, and they had much more of a public company mentality as opposed to a private company. You know, this is my child and I've invested in this, and so I'm going to make it successful, to a public company board, which has a very different outlook. And they wanted to see evidence of how the company is going to move to profitability quickly, because the company had already been in existence for over 10 years, you know, was not making money. So there's a lot of pressure from the board on the executives in the team, in the company, to show, you know, how projects are moving and how they're going to be successful. And there were some major investors still that owned chunks of the company, and you also had pressure from them. So between investors and the board, you know, obviously they want return on investment. They want to see the company succeed as quickly as possible, which was one of the drivers for the whole pivot.
And is it surprising that it took, I mean, from 2003 to 2016, that showed some patience, right? But maybe by the time you were getting there, they were running out of patience?
Yeah, so for a lot of those years, the company was funded by one single entity who was a major investor in the company. And for them, you know, this was a large family office that was funding it. And it was for that, the founder of that family business that was investing, this was almost like a hobby project, if you will. and they were willing to continue to fund it. And the management of the company continued to invest in cool technologies. So everything they did was really cool stuff. But getting to profitability, that whole mentality changed once the company became public.
There's a follow-on question about IP. 200 patents is significant. The question was, couldn't Arcadia use that somehow to buttress the investors' concerns, because that would have significant value? Does that help you tide over the concerns of the investor?
Yeah, well, trying to get value for IP itself, again, has to be tied to when and how the products of that IP are going to get commercial. So if, in the case of GM crops, given where things are with GM approvals around the world, there's very, very few products that have been introduced in the last 5 years. And the industry has moved away from GM in many ways. And so those, that IP doesn't have, honestly, a whole lot of value anymore, because the time, you've got only so much time when the IP is valid, and if it's taking up most of that time to even get commercial, nobody is going to buy that, because they can see that this is going to take another 5, 7, 8 years to become commercial. By that time, the IP life will be over, and now what? So there's no market for that type of IP. You have a good market for IP if you can get the product to commercialize in a relatively quick lifespan, and once it's commercialized, you have a lifespan where you can get a significant return on the investment. Only then is that IP valuable. IP by itself doesn't have a whole lot of value.
So it was interesting, and I hadn't remembered this part of the story, but the origin was a licensing in of a particular technology at its early stage. So yes, somebody had figured out, oh, this is of interest, and it must have been on the front edge of something, of new development.
Yeah. Just think about it. In the early 2000s, with the glory days of GM technology, there were all kinds of traits being developed. It's almost like what gene editing is today, and traits were being developed by universities, by private institutions, public institutions, and then licensed out. But over time, the reality hit that particularly abiotic stress traits, yield traits, because so many genes are involved in regulating that, it becomes very difficult to make it work successfully as compared to an agronomic trait like a BT trait or a Roundup Ready trait, which you very easily know if it's almost binary. It's either going to work or it's not going to work. Whereas that's not the case with yield traits. But back then, this was the cutting edge.
So to the audience out there, what questions do you have? It seems to me like taking on what became a decision that you had to figure out what to do, and one of the conclusions was we have to cut staff and change the structure of the organization. That must have been unpleasant. Were there legal issues? Was it emotionally difficult to go through that? How'd that work?
Very, very, very difficult. So clearly, there's a legal component to that. When you're going to let go a bunch of people, you want to make sure you are covered in terms of what are the reasons for the reduction, and so you have to go through the legal process to make sure that you're okay there. And then it's a question of being fair, because it was not their fault. You know, they were working on a project that we've cut. You know, it's a question of being fair and giving them, you know, an appropriate severance, and treating the people right. You know, and I think we were able to do that well, and you know, the morale certainly went down, you know, the day we announced. But during that strategic review period, we were letting people know, we were being transparent, and every couple of weeks we were having a town hall. And you know, for a small company, it's very easy to do. We were letting people know that, hey, this is what's going on. You know, and then as we came closer to the decisions, we started to communicate that, look, we are going to have to reduce the number of projects that we're working on, and that's going to result in reduction of number of people. So you know, and people saw that, you know, people understood it. You know, interestingly enough, there were people who actually told me later, you know, we should have done this years ago. And what that told me was, people in the trenches know stuff, you know, and have that perception. And sometimes as management, you know, we can kind of get caught up in sort of these big projections and, you know, investments and all of that, and lose sight of really, is this doable? Is this realistic? And there were people in the company who saw that coming, and they were actually glad. And obviously the people who stayed on were glad that it got done. But yeah, we had to go through this valley, really deep valley, for a few months, and then had to come out of it. So 2017 and 18 were sort of the, you know, coming out of this valley years.
And this is the question here that just came up is on this theme here. So what was the first step in recognizing that the company wasn't focused? How did this, you know, suddenly, or not, I don't know whether it's suddenly, how did this come to a head? Is, oh, we better do something?
So I think I mentioned earlier, you know, in 2015, when the company went public, a new board had come in. So the new board kind of saw that things were not quite right. Obviously, the company wasn't making money. Like you said, you know, they've been around for 10 years, 12 years, and they still hadn't made money. So what's the problem? So they knew there was, you know, something was not right. But the people on the board didn't know quite how to fix it. And they said that, yeah, we need new leadership to come in. And so they, you know, went out and looked for people who had experience commercializing these products. And frankly, when I was interviewing for it, I saw that, you know, I even at the interview, you know, I was able to say, look, I mean, these GM products this is going to take a long time to commercialize. And that kind of, you know, the light bulb went on for the board right then. And, you know, having gone through it many times at Monsanto, you know, going through projects and picking the, you know, which ones are going to get successful and not successful, you know, we were able to go in and do these detailed project reviews and a strategic review of every project the company had.
And I think you said in there were some of the employees who had already figured this out, that the leadership didn't understand that it should.
Yeah.
Were the employees engaged to help the leadership understand?
Yeah, I mean, some of them were. I think some of the leadership did understand, but I think there was a heavy investment in a lot of these technologies. And, you know, I think, you know, why they didn't make these decisions earlier on, I think that's a great question. You know, why didn't this happen earlier? I don't know. I couldn't answer that question. I think people, you know, were just invested, and once you get caught up in these projects, you're just sort of on a treadmill, you know, and you want to keep doing all the right things to make these projects successful, and you lose the forest for the trees, I think.
It sounded like your downsizing process required a lot of sequential communication.
Yes.
And transparency. Did the I know it must have been heart-wrenching for many, but in the end, do you assess that the employees felt that it was handled in a fair and transparent way?
Yeah, when we did the exit interviews, the feedback we got was generally pretty positive. We didn't have a single sort of irrational type of a reaction from anybody. We had explained it to them so many times over a couple of months that people could kind of see it coming, and then it was not walking up to the desk and walking them out the door. It wasn't quite like that. We gave them notice. We gave them some time. We give them some severance. So obviously, and again, in a small company, in some ways that's easy to do, but in other ways it's hard to do. I mean, we couldn't give the type of packages that a Monsanto could give, so obviously, I mean, there was not enough cash to do that. But on the other hand, people don't expect that kind of a package either. And, so you have to find what's right for the company at that point in time.
One of the questions just came up was, in your explaining the downsizing, did you walk through the financials? Was that transparent?
Well, you cannot walk through every single dollar or penny, but you can, because obviously at that time it was a public company. We cannot disclose all of the financials, but we were able to sanitize, let's say, charts to show when the money would run out, and what our costs were and what our revenues were. We were able to sort of show that to people. This is what's going to happen if we don't do anything, and the whole company will have to get liquidated and go bankrupt in 15 months, 18 months from now. Or we take these hard steps now, we save the company, but half the people continue on. We really focus on 3 or 4 projects instead of 25. And then we'll be able to raise more money. And by taking all these tough actions, investors will see a path to success, potential path to success, which today they're not seeing. We're not able to raise money. And so, once people start to see that, we'll be able to raise more money, which we did.
What else out there, folks? We got a few minutes left. One of the things I thought was interesting, you said that you renegotiated the terms with your business partners. That must have been fun. You can say, yeah, I know we agreed, but things have changed.
Yeah. I mean, on their side, also because regulatory approvals are getting delayed. So actually, they could see, they had committed certain royalty percentages and so on. And what they were seeing is, hey, their cash flow is not going to happen for another 5, 6, 7, 8 years, because we had approved, we had licensees in Europe, we had licensees in Asia, in India in particular, we had licensees in South America, and there's no traits getting approved in any of these parts of the world, other than agronomic traits, and Arcadia was not an agronomic trait. So, they also realized that it's going to be a long time. In fact, one licensee actually discontinued that project for which they had licensed the trait from us. They said, no, we're not going to commercialize this. So we both did sort of a cashless exchange of assets and so forth, and we called it a day. With another company, we had joint funding of some trials, and we both said we're not going to do that. So both companies agreed. with another company, we said, okay, we'll reduce the milestone payments, but maintain the royalty. So there were different arrangements with different companies that we had to do.
Another question just came in. As a small biotech founder, this person is asking, because one can grow a company by themselves and own it all, when is the right time to get an investor involved, and what's the right way to find that investor?
Okay, so if you're the founder and depending on what you're going to need in terms of dollars for the next phase of growth. So if you're self-funding or you're getting funds from friends and family, who've invested in you to get you started, and you've got to a certain point and now you're running out, you need to lay out a plan on what products are going to come out of this technology, of this science. When is it going to be out there? What the potential revenue is going to be? What's the demand for that type of product going to be? Or is there competition? Are you a me too, or are you a novel technology resulting in novel products? And then based on all that, you can then make a pitch to different venture capitalists like the Yield Lab or others, or Biogenerator in St. Louis, and what have you, and try to get funding that way.
Yeah.
I don't know if that answers the question or not, but.
Yeah, I'm Charles. Actually, I'm from Intech Genomics in Phoenix Center. I started the company 2013. Basically, just my wife and I. Right now, we grow the company still pretty small, 10 people. We mainly operate through NIH SBR program, and but we also develop molecular biology reagents and kits. We grow that molecular biology reagents, in the past 3 years, 100% each year. So we haven't have any outside funding. So it's we are growing. We are still, like I just told you, 100% for the reagents. We still last year, during the pandemic, our sales are around 700K, 750K each, still pretty small. And, we grow pretty good, but we're still, all the funding just by yourself is still really slow, right? So I'm consider investors, but as a small business, the challenge is, I'm a scientist founder. I'm not a business person, and the right time or right investors, how you can do that perfectly, accelerate your product sales simultaneously, without the investor pressure, or do it. That's kind of question always in the mind. How
sure.
Well, conventionally with the right investment, with the right build the right team.
Yeah. I think you're fortunate that you're in St. Louis, because St. Louis has developed a really good infrastructure of incubators that have people that can actually help you. So you could work with, let's say, the Biogenerator, at Cortex Innovation Community or the Helix Center, and they could put you in touch with people who could help you build a business plan and a business case to say, I expect to grow in the next 5 years from, 700,000 revenue to 2 million, and this is how I'm going to go. And for that, I need to expand my lab. I need to add a commercial person and so on. And so I'm going to need, X number of dollars to get me through from now to 3 years or 5 years, and build that case, build that business plan, and then apply for funds, either through one of the different agencies out there or venture capital companies?
This always goes faster than one would think. We're at the end of our hour. I want to thank everyone, and particularly Raj, for you sharing your insights, and everyone else for their questions. For those who want to review, Venture Cafe will have this recorded and available on their website.
Thank you.
Yeah, it's been fun, Larry. Thanks for having me, and for all the folks in the audience. I mean, if you have any questions, particular to your particular situation, and you'd like to chat or discuss, privately, we can do that too. I think my contact details might be on the site, the Venture Cafe site, Larry, or you can get a hold of me through Yield Lab as well.
Yeah, I'm happy to pass the connection. I put my address in the chat bar.
Okay, great.
All right. Thank you, everyone.
All right. Thanks.